You should be able to see the chat. Yeah. All right, we live. Yo, what's going on, everybody? What's going on? What's going on?
How is the family doing tonight?
Good night. Good night. What's up?
We on real.
Seeking Alpha presents the top stocks of 2000.
Hold up. Let me turn this off.
Man, I'm glad you educating yourself about some stocks though. Anything could have played. Man, that could have been. Hey, listen, it could have been some internet.
Hey, y'all know what be in my background, man. There don't be no nonsense on this MacBook.
Man, I tell you.
You know.
I'm glad to see you educating yourself, brother.
Yeah. We here, we live. You know, we was a little bit late, so we gonna get right to it. We appreciate y'all checking in. We do got cousin Shanisha to the front. You know, she gonna teach us about some life insurance, and it's funny because I was just talking with somebody else about this the other day, just about how we don't really have life insurance, and you know, we was talking about how like it's like a TikTok going around talking about how if Black folks was to have life insurance, you know, we might not get killed by the police as much because the insurance companies might start lobbying to, you know, protect us a little bit more. You feel me? Because they would have to come out of pocket for that. And you know, there was an interesting discussion that we had. You feel me? I personally feel like they would make some loopholes in the policies. But, you know, besides that, it's always mandatory to have insurance. And Shanisha, you know, she definitely is going to bless us and let us know why. So I'm going to let you go ahead and have the floor. And, you know, we're going to tune in with you.
All right, let's do it. And it's actually interesting that you said that, you brought that up, because that's something I've been telling people for years. Like, big business will step in, right? Because that's when it affects their pockets. That's like, think about it when we think about anything in the market, when it starts to affect us, we're gonna step in. Think about right now with what's going on with Ukraine and all this, right? You see a lot of big companies like pulling. Why? Because they know if they continue certain relationships, it's gonna mess up their money over here, right? So just thinking about that, that is something that's very powerful. And it's unfortunate that it took someone of a different color to kind of bring the awareness out, you know, but whatever gets the people going, right? And so now it's time to put education on it. So real quick, I'm going to go into a little bit about me and who I am. But I want us to understand that it's not just life insurance. Life insurance, it's about the whole wealth building picture, right? It's about the protecting of our assets, right? A lot of you have spent the last couple of years really going in as far as learning the economics and learning the different strategies to build your wealth. Imagine that can be taken away with little things such as taxes, right? When you go to transfer that wealth when you pass, right? That money can be taken away because of maybe the volatility in the market, right? How do we protect our assets, right? And continue to build our net worth. So I'm gonna get into it. So again, my name is Shanisha Dixon Tyrell. I'm a financial coach. I've been in the financial service industry for approaching 10 years, and probably a lot younger than I look, right? But approaching 10 years now. And for me, it's personal, right? I've seen life insurance save my family's life. I've seen life insurance really give us a step up in the world. And just real quick, what I mean with that is, you know, I don't know if how many of you all are familiar with Y2K, right? When, you know, Y2K, right? So the year 2000, during that time period, my mom had lost her job. And when she lost her job, what happened was a lot of the companies were like, well, we can't help you. And she had all these type of investment accounts. We can't help you. You don't make enough. We can't service you, right? And so what I saw was that she took her life insurance policies. She took that money from the life insurance, her cash value, and use that money to actually sustain her lifestyle, right? And so we're gonna go into that, but you know, it's personal for me. That's what I want you guys to know, right? So I'm from Brooklyn, New York, right? So if you're from Brooklyn, light up the chat, let us know. If you're not, then sorry for you, right? And so yeah, so what we're going to talk about what is life insurance. We're going to discuss the two different types, right? Term versus permanent. We're going to talk about the myths, the different myths and facts about life insurance, right? taxes, infinite banking. I'm sure many of you probably heard that strategy before, infinite banking, and really don't know what it is. Long-term care, the dime method, and then, you know, or what dime is rather. And then if you guys have any questions, you can drop it in the chat and we'll see if we can touch on any. All right, so what is life insurance? So by the way, at some points, I'm going to just be going off the dome. The notes are for you all, right? So life insurance is a contract between you and the insurance company, right? And so basically what it's saying is that you pay your premiums every month or every quarter, whatever the agreement is. And then at the end of your life span, that's when we will pay out a certain amount to your beneficiaries, right? And the beneficiaries are the people that you left listed, whether it's a loved one or friend, whatever, you list those organization. These are the people that you listed saying that you want them to receive this benefit when you pass, right? So there's two main types of life insurance, right? Now, I know you're probably like, well, I've heard of different types. Yes, there are multiple kinds of policies, but there's two types of life insurance. You have term, which is temporary coverage, which covers you between 5 and 30 years, right? Now, term is typically a cheaper, more affordable policy, right? However, you can get a lot of money coverage for this cheaper amount, right? The thing is, though, it's only for 5, it lasts for as whatever your term is, whether it's 5 years, 10 years, 15 years, up to 30 years max, right? And then you have permanent coverage. So permanent coverage has two components, right? It has a cash value and a death benefit. The cash value is the money that your family, the cash value is the money that you have access to while you're alive, right? This is money that you can take out, whether it's in the form of a loan, and depending on the policy, it could be in the form of a withdrawal, right? And then you have the death benefit. That's the money that your family gets in case of your passing, right? With the term policy, you solely have a death benefit. There's no cash value. So solely a death benefit, 5 to 30 years, and then the permanent policy is a cash value and a death benefit. And this lasts for the total duration of your life, right? Now, most people heard of what's called a whole life policy, right? And whole life policy is just one type, it falls under the permanent realm, right? There's different types of permanent policy. So I want you guys to probably heard this before, right? That permanent is what it is, right? And then there's the whole, then there's different types of policies, which we'll go through. Right? So what are the benefits? Because I think what happens is that a lot of people, especially people that look like us, right? They don't necessarily find value in the insurance, or not finding value in insurance. What happens is that, and this goes back deep, right? We have a history with insurance, right? And so you kind of said something earlier, Tiva. It was like, I feel like they're going to create loopholes, right? And so because of things that happened in the past, we don't really see the value of insurance, right? But I'll touch on that real quick. Let's go through what's the life insurance benefits. First things first, you can create living benefits. A lot of time people feel like, oh, well, life insurance is if I die, right? How does that benefit me? First things first, here, right? Us cousins, we don't even have a us mentality, right? We have a generational mentality, right? Am I correct? So because we have a generational mentality, it's not even just about us first and foremost. So I know I don't have to worry about that here. But the thing is that, what better way to use your policy than for you to use it, right? And so when you look at your life insurance, it's called life insurance for a reason, because of those living benefits. So there's things that you have access to while you're alive. And then you can supplement your retirement income, right? So now people often say, oh, there's a lot of misconceptions. I don't know if I would get a policy and look at it as an investment, et cetera, and so forth. First things first, I want to tell you this. If you're ever dealing with an agent, you need to deal with an agent that is not biased, right? You need to deal with an agent. And this is another thing. Sometimes we feel uneasy because we don't really know who to trust, right? You need to deal with someone who's a strategist, someone who's well-educated and well-versed, someone who can deal with all types of policies, because if I can only serve one policy, then I have a bias, right? Like Bank of America, you go to Bank of America and say, I want that Chase account. They're not going to give it to you, right? They're going to sell you on their account. So you got to think about one that's not biased, and you want to think about what best serves you. And now, just because you get a policy right now maybe one type of policy serves you right now, and then later 5, 10, 15 years from now, you may need a different type of policy, right? So that's what you want to have in mind, right? So it can depending on the policy that you have, it can supplement retirement income, right? So, and depending on how it's structured. Now, it can cover educational expenses for your children, right? Some people may have heard of plans like the Gerber Grow Up Plan, right? I'm not promoting any plan. I don't, it's not my forte, but many of you may be familiar with it, right? And so the idea of that is if your child turns 18 or, then they decide to go to college, they can use that money towards school. Now, you just have to ask yourself, is this enough money to really do the things that I need for the schooling that I want my kid to have, right? However, that's just that one type of policy. Other types of policies really can set your kids up to cover education expenses, right? Then you have replace income for your dependents, right? Think about it. If you have children and they depend on your income, what happens to your income when you pass? Your income stops, right? So they're relying on your income. So what happens is now, because you left a death benefit, it's going to leave that for your children. It's going to cover final expenses, right? Funerals are like 8 to 15,000. Really, you can get away with 8,000, but these funeral homes understand they're predators. They understand that you are mourning, that you don't really want to be dealing with this, and so they know that you want the best for your relative. And God forbid you and your relative had a falling out. You feel bad. You really want the best for them, right? To kind of make up for it. So what are they doing? They just adding on all the features, taxing it, adding up, right? So now you paying out $15,000 for a funeral, right? So now we're in a time of inflation. What a funeral is going to cost 10, 15, 20 years from now, 40 years from now, right? So just thinking about that, paying final expenses, then creating an inheritance for your heirs. Obviously, we're not here just to kind of help our family get by. You have to ask yourself, do I want my child or my family to be in a worser, same, or better position, right? Pay federal and estate taxes, right? This is so important. When we look at, and we'll talk about this, but when we look at wealthy people have insurance, not for the fact that they need insurance because they need an extra million necessarily. They have it to cover its taxes, right? That's one reason why they have it. I'm going to have this money, set it to the side. And because I'm going to set this money to the side, when I pass away, my family will get this money. Then they're going to have to pay these taxes, but I have the money over here to cover that for them, right? Create a source of savings, right? Again, if you have that cash value policy, again, it could be used as a source of savings, right? Provide funds for charitable contributions. This is one thing. If you are someone, especially if you're someone who's like a church goer, or you have an organization that you love and you really, really care for, what happens is that, well, you have these organizations you really care for, but you don't do anything to really contribute to them. You know that you can contribute to them even when you're gone, right? If you look at that church building, anybody got that church building that's still been being built? It's been like 20 years now, right? Half finished building, no shade, but we know it, right? You done had 25 people, elders, pass away in the church, and that building still can't be built. Why? Because no one is in a position, or if they are, they're not thinking about it, leaving to the church, right? So you could provide for your charitable contributions. So there's different types of permanent policy, as I touched on earlier. So you have whole life, you have variable universal life, you have universal life, you have index universal life, right? And so most people know a whole life policy. And so when you think about the whole life policy, I want you to have this in your mind. Think about like the flip phone, like you remember the Razor, right? It was once upon a time the best thing out, right? Now we are on iPhones, right? And for you Samsungers, you are on the Samsung, right? And so when we look at, no shade, y'all, don't kill me. I want to be invited back, right? No, so yeah, when you look at it, that's what this is, right? There's an evolution taking place, right? So the whole life policy, it's definitely, the idea of it is a great policy. However, they've built upon it, right? And you will go through it. But like the variable universal life, that's like you have your money in the market, right? Because it's variable. So it's actually in the stock market. And then you have the cash value that actually is invested in the stock market. You could purchase stocks and stuff with it. The good thing is that, you get that advantage if the market is going up. But if the market is going down, so is your cash value, right? Your account is going down too. So you have to keep that in mind. And then you have the universal life where there's just a flat interest rate pretty much that you're getting, right? So a flat interest rate that you're getting. However, with all the universal policies, the premiums are flexible, right? And so the reason why that's an advantage is sometimes we have tough months, right? Sometimes we go into a position where we're like, all right, this for the next 2 years, I'm ready to start saving towards a house, right? So you want to know that maybe I can go down $50 on my policy, right? Maybe I can go down $100. You also want to know, like, maybe this is a season for you where you just getting bonuses, extra commission checks, who knows, right? So now you can actually, I want to overfund my policy. I want to put more into it. You also have that option as well. So these universal life policies have flexible premiums. Now, universal life is a little bit more dated than the variable and the index, right? So it was like whole life, then universal, then you have your variable and your index, right? And so universal life, again, it's great, but it has some flaws, right? And then you have index universal life. And so with an index universal, we all know what the index market is, right? And so what they do is it mimics the index, right? It mimics whether it's the S&P 500, or if we go global markets, the Dow Euro or the Hang Seng, right? It's mimicking those indexes to give you a return. And so what happens is that the money there is not in the market, but it grows reflective of the market, right? So now you're not in the market getting taking on any risk, right? This policy also has what you call locks and gains. So what happens is that you're getting a credit. So the insurance company is giving you a credit based off the performance of those indices, right? So let's say S&P 500 is performing at 10%, right? You're getting a 10% return, right? Now, or maybe maybe they'll give you like an 8%. They'll take 2% for themselves, participation. They'll take 2% for themselves and give you 8%, right? So you have no risk. So now the beauty in this is that, again, it has locks and gains. So now let's say you have $100,000 in your cash value. If the market goes down, what happens is that it locks in that $100,000 value. The market goes down. You don't lose any dollars, but what changes is your interest rate. So instead of you getting 8% now, maybe you're getting 0.75. When the market goes back up, your money starts growing again and the interest rate goes back up. You understand? Now, I gave the interest rate. That's an example. Every company offers a different interest rate. So I just want you to keep that in mind. We didn't give any disclaimers, but yeah. So let's look at the different types and kind of like what the benefits are. I kind of touched on it. So you have term, right? Now you'll probably hear things like term is better or whole life is better. There's really no better. I want you to understand that it's really no better. It's about what benefits it works best for you, right? It's not a better. Everybody's situation is different, and at some point it may require one over the other, right? It may require both, right? And so so don't listen to anyone trying to feed you a lie, because a lot of times people will say, and we'll touch on this, term, and that's it. Buy term, invested difference, right? Well, let me ask you a question for everyone. Buy term, invested difference, right? Some of you just started investing. You got a little scared, huh? So you took a year off, right? We took a few months off, right? To learn. That's okay. We took a few months off to learn, right? To go back to the drawing board, and that's okay. But what I'm saying is, now, let's say you had the intentions, right? Let's say we were going to run like the rolling fours, or something like that. If we were going to run that, but we took a year off our plan. That set us back. God forbid we pass during that time. If we have a term, that's great. But imagine we were 30 years out. We got a term and we were 30 years out and you passed away. We wouldn't quite make our goal, right? We didn't expect a World War III. We didn't expect, right, all these things to take place, right? Not saying it doesn't happen. Let's talk about where were you prepared for it, right? So everyone's situation is different. And so no one can say, oh, one size fits all. Because I had a client whose parent died literally one day before his term policy ended. How easy could it have been for her to forget to renew, right? She was like, Shanisha, thank God. And I don't mean it like that, but I would have been in a crazy mess, right? Imagine. So I just want us to be cognizant of the message that we're sending out when we say, oh, one is better than the other, because that's not the case. So yeah, so death benefit. So these are what, when we're looking at the comparison, right? So you have death benefit, you have whole life, you have universal life, you have variable universal life, right? They all have a death benefit. When we look at economical, obviously term is the most affordable. But now you have to ask yourself about value, right? Where does the value come in? We'll go through that. So you see that the rest of them, they're not as economical, right? They're not as affordable. However, they can be. It all depends on what are you planning to do with your policy? What's your goals for your policies, right? And that's where the price is pretty much dictated. Also at points, your health, at what point in your life you're looking at this policy. Like there's so many different factors to it. So the earlier, the better. So yeah, so access to cash value. As you can see, the last three have access and term doesn't. Guaranteed minimum interest rate. They all offer, except for term, a guaranteed minimum interest rate. I'm sorry, except for term and VULs. Market participation. Only the VUL offers market participation. Remember, the universal life, the index universal life, well, the index universal life, it mimics the market, but it's not in the market. So it's still not considered market participation because you're getting a credit based off the market, right? Tax advantages. They all offer tax advantages. When you look at the purpose of life insurance, the life insurance, they didn't want to put a tax on the money because they were like, originally, it was like mostly the women were receiving benefits, right? Their husbands would go off to war, they would pass away, then they would receive the benefits. So the government was looking like, that'd be kind of messed up if I go and tax these women who just lost their husband, right? So that's why they was originally not putting taxes on the policies, right? Now, if we'll go deeper, but policies, cash value policies are backed by the IRC code 7702, but we'll go through that, right? And then flexible premiums, right? Universal lives policies are the only ones that offer a flexible premium, right? Whole life policies is what they tell you to pay every month is the amount that you have to pay. So the living benefits, which we kind of touched on, right? So yeah, so the basic need of life insurance is to protect your loved ones, your business, your state if you die. However, in many cases, the insured may have great needs at time while they're alive, right? And so you have accelerated death benefits, right? So that means like if you happen to get like terminally ill and you need your death benefits to whether it's going to pay for treatment, right? Things like that. What happens is that the company will accelerate your policy, right? Then you have, in case of serious illnesses like heart attacks, like strokes, cancer, paralysis, all of that is terminal illnesses, right? Those diagnoses, where you have like less than 12 months. The other thing is that you have the long-term care feature, right? Which we'll touch on a little bit later, but that's also something that's super solid, right? So you have myth versus fact, right? We want to talk about these two. So a lot of times, some myths are people believe it's a meal ticket, right? They like, I worked so hard. So I worked hard, so you have to work hard. Can we imagine that like people are saying that about their children? I worked hard, so you have to work hard, so I'm not getting any insurance, right? Like, why would we not want life to be easier, like for the next person, right? Imagine how much further we would be, right? And you know, and this is even why like I'm grateful for things, you know, organizations like the Come Up series, because there's a lot of people who probably can't afford a monthly rate, right, on some of these classes, and yet everything is being given for free, right? So if I had an opportunity in life and I can make it a little bit easier for the next person, why not, right? And that's what that, unfortunately, people don't believe in it, right? So passing down wealth does not create lazy people. children, right? Financially reckless children, a lack of financial education does. So I always tell people it's not just generational wealth we need to pass down, but it's generational knowledge, right? So with generational knowledge, that's what's most important, passing down generational knowledge as well, because if your family only knows Section 8, guess what their aspiration is going to be? Let me get into Section 8, right? $300 a month. And that's no shade. It's just what it is. If your family only knows, you know, if their family knows wealth, then they're going to attribute to wealth. So we just have to understand that if we pass down the education along with, and the resources along with the money, we're setting our kids up for success. People say it's only for deaf purposes, right? We already established that there's living benefits, right? Cash value loans, withdrawals, accelerating your death benefit, long-term care, right? Some people say I'm single or I'm married with no children. I don't need life insurance. I want you to understand that who you are today will not dictate who you will be tomorrow, right? And so because of who you are and what you are today does not dictate what you will be tomorrow, we have to keep in mind that you may be single right now, but tomorrow you may want, you may fall in love, right? You may have a family. And so if that's the case, you want to make sure that you're properly positioned for that, right? It's better to start sooner than later. Fun fact, right? When I first started in the industry, I encouraged my husband, I was like, we need to get coverage and we need to get a policy that supports one another, right? So if I pass away, this benefits for you, and if you pass away, this death benefits for me, right? And he was like, all right, and in the beginning, even his mom was like why? Like, we don't need insurance. Like, you don't need insurance. I have a policy for you. And I was just like, that's not the mindset to have, because she has a policy for you, but I've never seen it. I don't know it exists. What if anything happens? And what if she doesn't like me, right? And decides that she doesn't want to give me, but she loves me. But what if she doesn't want to, give it to me for whatever need I have it for, right? Whatever the case may be. And so I was like, we're just gonna get one for ourselves, right? So he was about 25. Fast forward, my husband proposes to me 2 or 3 years later. He gets diagnosed with lupus, right? SLE. So lupus is an autoimmune disease, which pretty much makes you you can't. Sorry, I'm losing my words, but you can't get coverage, right? Uninsurable. You're pretty much uninsurable. Now things are changing and they want to monitor stuff. So depending on your situation, you may be able to, but just looking at, it's really hard to get, right? So imagine, had I not encouraged him to get that policy at that point, now we're married, we may have children, right? And anything could have happened. So I want you to understand that you don't know what tomorrow, this is a person who, he eats hummus for fun. He eats hummus and carrots for fun. Like, that's his snack. You understand? I eat Snicker bars, he eats hummus, and he gets sick. You understand? Like, it's crazy. Like, we can't determine what life is going to bring about for us, So yeah. Sorry, I can't afford yet. So basically back to this, you just have to get a policy earlier, the sooner the better, right? And obviously you can start small, and then as your situation changes and progresses, go bigger, right? I can't afford life insurance. That's not true. And almost anyone could afford a life insurance policy. It all depends on what, when you're starting, what type, right? If you can't afford a permanent, you can afford a term more than likely, right? I'm a stay-at-home parent. I draw no income. I don't need life insurance. That right there is the biggest misconception, because I want you to think about this. You stay primarily at home with your children, right? Now, let's say you're home with your children majority of the day while your spouse works. So your spouse passes away. I'm sorry, you pass away, God forbid. What happens? Your children are already conditioned to have a parent home with them all the time. You're now putting your child in another state of trauma and shock, because one, they just lost a parent, and two, they lost another parent because they have this parent that can't even step in because you have to go to work. So you need insurance as a stay-at-home parent, so that your spouse, the working spouse, can stay home and do what they need to do on the inside until your children get acclimated, right? There's so many questions and I want to answer some questions. I'm like, should I stop? Says, I don't need life insurance once my children are adults. That's not necessarily true. If we think legacy, right? So yeah, I have a comfortable amount of savings, so I don't need life insurance, right? Let's talk about this real quick. So a lot of people think like, oh, my stock account is lit, my savings account is lit, I don't need insurance. All right, let's talk about this. Imagine we're in a situation where now your accounts could potentially be frozen, your assets could be frozen, right? Imagine, and then you pass away. Do you know that like your money could just disappear out your account and out of your bank account? Now, obviously they have the FDIC, is FDIC insured if it's a bank. Obviously they have to account for at some point, but at what point, right? At what point, right? Imagine your money's in the stock market, the market crashes right before you pass away, you lose half your assets, right? Again, we're thinking, yes, these are worst case scenarios, but we have to think like this. We have to think with the worst and the end in mind in order for us to reverse engineer the process of building wealth, right? Because if you stay ready, you never have to get ready. Or as I like to say, the 5 Ps, you gotta go corporate. Proper preparation prevents poor performance, right? So those are the myths and facts, right? So how much do you need? So a lot of times people ask, how much do you need? I'm gonna answer a question real quick. Is it possible for any coverage, specifically term life, I can pay annually or a year in advance? You can pay. All right. So that was Daniel West's question. Yes, you can pay your life insurance. You can pay monthly, quarterly, annually. You can pay upfront. That is okay. You can pay. You can even do a single pay where you pay for all of it at one time, right? I don't know if that's necessarily my recommendation, depending on the kind of policy you have, but you can do that, right? Term policies do not require medical exam. Look, all policies, they will ask for a medical exam. However, there have been some exceptions due to COVID. They have been more lenient with asking for medical exams. They do check your medical history though. So whether it's term or permanent, the only time they really don't ask for your medical exam is if it's through your job, right? So if it's through your job policy, they're not really asking for any medicals. But right now, medicals really pretty much are waived, right? Depending on your age range, depending on your health situation. So how much do I need? So we use what's called the dime method to determine what you need, right? You have your debt, your income, your mortgage, your education, right? So a lot of times what happens is that, and I want us to talk about some fun statistics, right? So us Black people, right? And I'm going to talk for us, the majority, right? And this is for us, we do get coverage, right? So I want to applaud us. I want us to know that we do step up and we do the things that we try, right? Because a lot of times it's like, it's kind of harsh on us. Like we don't do this and we don't do that, right? We do try. But what happens is that we don't have enough, right? We are heavily underinsured. And so let's say it's 1 in 3, the statistics, right? So for every like 100,000 that we'll have, our white counterparts will have 300,000. Right? And so that's a big difference, because that's the difference between having a funeral cost covered and then having wealth built, right? Now, obviously not 100,000, 300, but just saying, right? Those kind of numbers, right? We're looking at how can we just pay for final expenses, whereas they're looking for the legacy part of it, right? So you want to determine your insurable needs. So a lot of times you'll determine your insurable need and you'll be like, wow, I didn't even realize I need this much. So now your debt. Now, depending on what state you are in, certain debt cannot be rolled down to you. So I just want you to know that, because a lot of times we put pressure on, oh, if I die, then my family will have to take on my debt. Not in every situation, not in every state, right? So like in New York, where I'm at, we do not have to take on that debt. If your family had credit card debt, student loan debt, we do not have to take on that debt. You just put in some paperwork to prove that that is completely on debt, right? The only time you may have to take on debt is if you were what you call it, you sign on it, I forget the term, but y'all know what I'm talking about. So when you sign on their debt, right, that's the time you'll have to take it on, right? Sorry, I forgot the term. The other thing is income, right? You want to have at least 10 times your income. The go-to number is 20 times depending on the age of your children, but at least 10 times your income, right? So think about this. Imagine you have a 2-year-old, right? Your 2-year-old is probably not getting out your house until they're about 20 years old, right? And even that number is different now, right? So let's say 20 years old. So now for the next 18 years, if God forbid something happens to you when your child is 2, they were going to be relying on your income for 18 more years. So you have to calculate for 18 more years how much income you potentially would need just in case. Because yes, we could say, oh, grandma's going to take care of them, daddy's going to take care of them. But I want you to understand that nobody is going to take care of your child like how you take care of your child, right? You might go the extra mile and get your child a pair of Jordans, all right? But then your grandma probably going to say sneakers are sneakers, right? And so we just have to understand that we're willing to do more sometimes. But we're not buying Jordans, y'all, right? We buying stock, right? so, so unless we teaching them how to do trade on StockX, right? But yeah. So co-sign. Oh, thank you. Yeah, that word is co-signer. Thank you. Co-signer or guarantor. So for debt, right? So unless you are a co-signer or a guarantor, then yes, that's the only time you may be responsible for their debt, right? But yeah, so for income, you want to go at least 10 to 20 years out. So now, yes, if your income, let's say, is 100,000, you got to times it by 10, you got to times it by 20, right? And that's how much income you're going to need, right? And now you're probably looking like, whoa, these numbers are too big. That amount of insurance is going to cost. This is why you need a strategist. You need someone who can help you put together the type of policy to stay within your budget, but still cover your insurable needs, right? Mortgage, right? If you have a mortgage, if something happens to you, your kid can't take on your mortgage, right? So you want to make sure that you account for that. Can this day cover my mortgage, right? You may want to think about having a term policy to cover your assets that are temporary, like a mortgage, right? So typically a mortgage is 30 years. So what I may do for a client is put a 30-year term policy in place for them, right? So I put a 30-year term policy in place for them so that this way, if anything happens within the 30 years, then they can get that. Let's say it's $400,000 left on the mortgage. They'll get $400,000 and they can use that towards the mortgage. But if let's say they don't, nothing happens to it, you pay $10,000, right? Just look at it as tax on your property, right? But you were paying for the peace of mind to know that if something happened to you, your kid would be able to sustain. Because if your kid can't pay the mortgage, what happens? They go forced into foreclosure. Now you're selling the house at a lesser value. You're not even getting what you should. You were trying to create wealth for your child with this property or a home, right? And now they don't have that option anymore, right? And then education, right? If you want to plan for your child's education, so let's say you say, I want my child to go to Ivy League, that's going to be $100,000. Then you got to consider that if something happens to you prematurely, how are they going to pay for that education, right? So yeah, if we leave a job, can we continue paying for the same life insurance, or is it best we get a new policy? Okay, so I'll probably touch on this a little bit later, but I'll touch on it now. If you have a policy through your job, I absolutely recommend that you have an additional policy. Policy through your jobs are just extra, right? We already talking about this walkaway life, right? So you're going to be walking away from that job. You won't have that job for too much longer. Now, some jobs will allow you to take the policy with you. Then other jobs will not. Right now, you have what's called sometimes people say, well, I'm vested, right? I worked 10 years. I worked retirement at my job. I'm vested, right? I want you to understand this, and you don't have to double check my work. Remember, that's what we do. Do your due diligence, right? Double check my work. Call your HR. Ask them, if I become vested, how will this work? How can I take my policy? What will happen typically is, like, let's say you have a policy that matches your income. So let's say it's $100,000. Right? The first year you leave that policy will probably decrease by half. So 50,000. And then it will draw down every year until it's about $10,000, and they'll leave you with the $10,000. So you thought you had a $100,000 policy, but really you have about a $10,000 policy. They want to give you just enough to cover the bare minimum. So I want you to keep that in mind, right? The other thing is, sometimes people feel like, well, I have a health concern. I may not be able to get coverage. Here's my little hack. If you have a health concern and you may not get coverage, if you have a job and your job offers you a policy, call your job and ask them, all right, if I leave this job, can I take this policy with me? Even if I'm paying more premiums, right? If you, and that's typically what happened. If you leave, they'll allow you to, but you pay significantly more premiums because you're not part of that group rate, right? So now, can I take my policy with me? All right. Do I have to test? Do I have to do a medical? They'll probably say no. Okay. So then they'll say, so yeah. So do I have to test? And so and if they allow you to, and if they what you do is you get a policy through your job, because that may be the only policy you can get, right? Or at least for a while until your situation, if it can get better, you understand? So I just want you all to know that that's the only time that, and when it's extra, just consider it extra. Have something standalone, right? All right, so when do I need a life insurance? How often do I review my life insurance? So a lot of people are saying, well, I have a life insurance, I have a policy. Well, I want you to understand that you may have a policy, but you have to keep in mind that your policy is probably outdated, right? You change your iPhone every few months, right? Why are you not changing your policy, but why are you not reviewing it, right? As often, we should be going to the doctor every year. You should be reviewing your financial, everything, your full financial portfolio every year, including your insurance, right? So if you just get married, that's when you should get a policy. That's when you should be reviewing your policy. If you have a new family, if you start a new family, that's when you should get a policy. That's when you should review your policy. If you have established family, meaning like you're still building, right? There's a new baby, right? Your family's growing up. There's different needs. You should now, again, get a new policy or review your policy, right? And when you're retired, when you're gearing up for retirement, right? You should be reviewing your policy. That's most important. A lot of times, and you want to review it way before you get to that age, because then it costs more. It costs significantly more, you know? So we kind of talked on buy term, invest the difference, right? So the idea is buying whole life policies are expensive, right? The cash value has too many fees. First things first, I want to tell you this. Go to your 401k at your job and tell me how much fees they have. Yeah, okay. Right? Your 401k has tons of fees. Most retirement accounts, right, are gonna have fees, right? And the ones that are more attached to another entity, such as your job, you're gonna have even more fees, right? So fees are part of the picture. People got to get paid, right? But you're also getting paid. That's why you look at the value. What value am I getting in return for these fees, right? And then they say, so the challenge is this. Again, we talked about it. If the market goes down and you haven't really prepared for your situation and you think buy term, invest the difference, you might find yourself in a tough situation, right? It could be right at year 31 where something happens. And if something happens and you have a term policy, so actually, let's look at it this way. If year 31 rolls around, you have two decisions. You either get a new policy at that new age, right? So 30 years, so for me, I'm 31. So 30 years from now, that's 61, right? So I'm either going to get a new policy at the age of 62, and it's going to be significantly more, right? Or I'm going to decide, no, I don't want a policy, and maybe the market crashed right before I could even transfer my assets and do what I needed to do, right? Again, we have to plan with the end in mind. When you're looking at, we all know compound interest in the rule of 72. When you look at like policies like the IUL, the Index Universal Life, these policies have the index, I'm sorry, they have compound interest, right? And so your money, your money is growing, I'm sorry, your interest is growing interest with these policies. So you have to keep that in mind, right? And so you need to have interest rates that are compounding at a higher rate, right? So right now, like most people think about CD accounts, right? Oh, I'm gonna get a CD account. That's so ancient. Obviously, I know that we're more knowledgeable here. We know about that. Like that's not it. So we're thinking 10% higher because we're thinking about what mimics the index, right? So if you look at, if let's say you had $10,000 in your cash value and it compounded at age 65, you have $320,000 if it was getting 10% every year, year over year, right? Now for us, we probably looking like, well, I don't want bigger numbers, and you can get bigger numbers, but I'm just showing you what could happen at a 10% interest rate versus a 4%, which is what people's CD accounts are getting, right? When you get scared out of the market and you put your money into bonds and whatever the case may be, right? This is what's happening. You're not getting any interest. You keep your money just sitting in a savings account. You're not even getting 1%, right? This is why our money has to be working for us, right? At all times. So when we're looking at any investment or any place that we're putting our money, how can our money work for us in multiple ways? So taxes, right? Those who understand the tax game, they understand they win the game. And so if you understand the taxes, you will win the game, right? So so Section 7702 is the IRC's tax code. Basically, what it says is that if any person who puts their money in a cash value life insurance policy, right? Anybody who puts their money in a cash value life insurance policy, that money will grow tax-free, and you can withdraw tax-free. Your money, you can withdraw your money tax-free, right? Now, let me tell you how powerful this is, because we got to think like the wealthy, right? The Congress had a vote on should we to get rid of the IRC tax code 7702, right? And the vote was 400 to 0. There are 400 members, and every person said no. It was a unanimous decision that no. Why would that be? Let's think like our cousin, our great cousin Nancy, big homie Nancy, right? like we got to start thinking like these politicians. Why would they vote against it? Because it's for their benefit, right? So we have to understand that there are opportunities, there are ways to go around. It's not tax evasion, it's tax avoidance. And that's what we have to start to think as, not tax evasion. We're not trying to get over the system. We're just trying to go around the system like the rest of them are doing, right? So only permanent policies are protected by the IRC tax code 7702. Let me see if I could answer any questions real quick. All right. So yeah. Infinite banking. So a lot of people are talking about the infinite banking strategy. And it's unfortunate that we have to make things super sexy for us to be attracted to it, right? Sometimes when it comes down to wealth building, some things won't be attractive. Or it won't, like economics to me is not fun, right? Like I got to hear like the interesting part of it. Like economics to me is not fun, just sitting there reading, however, it's necessary. We cannot be in this game and not know what we're doing. We're not focused on the economics of things, right? And so this is what, like, how I think about infinite banking, right? It's a strategy that is used where you can use the policy to be your own bank. You have to have a strategist in order to set this up and do this right? But I want you to know that we need some people here, they just need a regular policy, and there's some people here who need more, right? I just had a quote recently done, 35,000. All right, I'll touch that later. But what is infinite banking? So the process of becoming your own banker, right? So for example, let's say with a whole life policy, right? What happens is that you have, let's say you have $100,000 in your cash value, and then you have $100,000 death benefit, right? Let's say I take out $50,000 in my policy, right? So I take out $50,000 in my cash value. So now I just took out $50,000 to go purchase a house, put down money on a house, right? And I still have $50,000, right? I could be spending my own $50,000, but like they say, why spend mine when I can spend yours, right? So now it's technically my money because it's in my cash value, right? It's my money. But what's happening is it's coming to me in the form of a loan. So if it comes to me in the form of a loan, what happens is my money's still in there growing, but the insurance company just lent me their money. You guys got that? So they let me their money, and my money is in there growing. So while the money's growing, I'm out there using their money to buy properties, whatever the case may be. Now I get the return. I can take that money and pay it back, right? If I have a whole life policy, I'm gonna take that money and pay it back. But let's just say I don't pay it back and I pass away. Well, what happens now? My family they will deduct that $50,000 from my death benefit. My family will get the $50,000 that death benefit that's remaining, and then my family will still have this house that I bought. Now let's say we get real fancy with it and we structure IUL, right? I might not even get that deep with y'all, but I'm just saying you get real fancy with it. right? Now, I'm gonna give it to y'all because we cousins, right? And Mark put me in the matrix, and so I feel proud. So I'm gonna give it to y'all, right? So now let's say we structure IUL and we have $100,000 and we have $100,000, right? And let's say we're doing an increasing what you call it, strategy, right? So we're doing increasing strategy. So now what happens now, I take $50,000 out the cash value, go use that money to buy the house, right? But remember, it's still technically a loan. They're using they gave me a check and my money's still growing in there, right? Now, I have bought this property. I have $100,000 in my cash value. Let's say, God forbid, I passed away. Not only does my family get that $100,000 cash value, but they're going to get, the death benefit, they're going to get the $50,000 that's remaining in the cash value. So they just got even more money than I originally applied for. They got $150,000 plus they got a property that I just bought. And I never even had to pay that money back. That's $50,000 that was extra. You're using other people's money. All it is leverage, right? I'm putting my money in this account and it comes to me in the form of a loan. While my money grows in this account, I pay the money back and my money was working the entire time. There was no loss to me. But if I go and take my money out the bank to buy a $50,000 property, then I go back to the bank, I might not have more money or I have $50,000 less. You understand? There's no, I can't work with anything if there's nothing there to work with. So I hope that makes sense. Let me see if anyone has. First time we only have just our jobs. Should we wait and get another one after our child is born? No, I personally don't think you should ever wait because anything can happen. However, you get your policies now. This is to Jamar Thomas. You get your policies now, and then what you can do is when your child is born, you get and I'm talking about policies independent of your job, and then you get the policy for yourself. For your child once your child is born. This is another thing. Get policies on your children. Please stop thinking, oh, they're too young. We don't know. We just talked about the example of what with Black people, how big business would step in. Let's talk about mental health real quick. Imagine, God forbid, your child passes away you can get a policy as early as 15 days. So God forbid your child passes away, and God forbid, within the first month, within the first year. These things happen, right? We never want to think about it. We do not, but these things happen. Why would you want to? I can't imagine that I would want to be in the same house or the same environment where my child, I would need to remove myself for a while, right? You have a policy, you can take that time to go remove yourself from that environment. You can take yourself to go to therapy, right? I don't know how many of you follow Dame Dash, but Dame Dash said that when him and his wife, before they had this baby, they had a child, they were expecting, and the child passed away, I think when she was 8 months or so, right? And Dame Dash said, I never appreciated being rich more in my life because I was able to take my whole family, move them to Hawaii, and just be focused on each other and get therapy and seek the best therapist to heal from that. And less than a year later, or a year later, they were pregnant and they have a beautiful baby boy, right? Let's talk about mental health. Let's talk about why insurance is important, period. You have insurance on your children. Unfortunately, some people live in certain environments where it's a little bit more rough. Your child passes away due to gun violence, God forbid, and you got to walk past the same spot every single day, looking at candles and reminder that your child would that couldn't be me. That can't be me. We have to think bigger than that, think on a bigger scale, Case studies, and I want to not take up too much time, but think Walt Disney, right? We talk about, life insurance doesn't work or whatever. And I get it, because if you look up Jim Crow insurance, right? This is history. This goes back to history. They did not want us having policies. They would give us the minimum only for burial. We weren't worth legacies to them. So they would do, when they gave us the opportunity, they gave us the minimum, which was, and we would get it. And we got it because we couldn't have it. And now we're passing down, remember what I said, generational knowledge, right? We're passing down these habits and we're getting the bare minimum. So now you have the bare minimum of policies being put out there, right? $10,000, whatever the case may be, right? When you have situations like Walt Disney, everyone said he was crazy and that his ideas was bonkers. He was not right in his head. No one wanted to support and fund him. Now he's one of the richest in the world, right? He has Disneyland and all types of other things that came about from that, right? And it was a loan from his cash value policy that got him started. J.C. Penney, right? In the 1930s, J.C. Penney was getting ready to go broke. They used their policy, the cash value, to pay their employees, right? So they went from thriving to a Great Depression, right? So we talk about the Roaring 20s, right? The Roaring 20s, right? Thriving 1920s. So all of a sudden, Great Depression comes about. Now they're suffering and they have to pay for inventory and their employees. And so they use their cash value from their policy to fund that. You have Ray Kroc, right? We know who Ray Kroc is, right? One of the best real estate people in the world, right? He got into McDonald's, and so what he used those policies, right? When things got tight to fund, to pay for his employees and to continue to build out McDonald's entities, right? So there's just some case studies as how it works on a grander scale. So we understand the power and the magnitude that we have before us. We have access to these things. We don't believe it because of we think we're going to get the short end of the stick. But if you fight for your rights and you stay strong in your conviction and you let people know that I understand ambiguous language, I understand my rights, I understand I can get a lawyer to read these contracts, you will know. And if you read the contracts, because we have to stop just signing, like you have to read things and understand what you're reading, right? Take the time to read your policies and see that your policies have to pay you out. It depends on the situation. Now, if you get the wrong type of policy, how is the company going to pay you out when you got the wrong type of policy? Let's say you got an accidental death and dismemberment policy, but you died from a heart attack. How are they going to pay you out? They honoring you did not die from that accident, so therefore they're not going to pay you out. So you have to read your policy and know what you have, and that's a lot of people's situation. All right, I'm gonna skip this part. So this, I'm gonna skip this. Basically, so this is what a insurance ledger looks like, right? But I'll go through that another time, right? Long-term care. This is another thing. I think we give our wealth away too much, right? We give our wealth away to these nursing homes too much. We don't care for our elders as much, and so because we don't care for our elders, we leave them in these nursing homes. And guess what? The first thing they do is they tell you to sign your assets over. Can I get your Social Security income information? Can I get your deed to your house? I need to put myself on the deed to your house as a lien. They do all of this because in case something happens and you default on them payments, they're gonna get paid regardless, right? So now long-term care is if it's a service in which it helps meet both medical and non-medical needs of people with chronic illnesses and disability. So let's say you can't perform 2 of the 6 daily living activities, such as bathing, dressing, toileting, transferring, right? That's like going to the bathroom. Continence, that's like the idea of even being able to open your pants to use the bathroom, right? Eating by yourself. You either need a home health aide, a nursing home, or a loved one to care for you. Who's gonna care for those needs? Those things become quite expensive. It's like, what is it, the number? I could like $9,000 a night in a nursing home. That's like a single living. It's crazy. In a single living, that's $9,000. That's crazy, but that's what it is. So now, so yeah, you can't. So if you can't perform 2 of the 6 daily living activities, it's gonna be 2% of your death benefit that's paid out to you on a monthly basis to care for those needs. And so we just have to think about it. How many of us know someone who's in a tough situation where they're probably taking care of an elder and, or feel obligated or feel bad because they can't afford to take care of an elder, right? If you take care of yourself, you don't got to worry about anybody taking care of you. You don't have to worry about being a burden to anyone later, right? Yeah, make sure y'all hitting that like button. So insurance for business owners. Whew. Key man insurance policy. So if there's any business owners in the chat, just like drop some money bags or something. Let's see if you're business owners, right? This is so important. So a key man type insurance policy is primarily for small business owners, right? And so think about it like this. When you have someone essential, like a Kobe Bryant, right? Do you think that they don't have policies on someone like a Kobe Bryant? If something happens to Kobe, you're right. And so something did happen, unfortunately. He was already out the league, but that doesn't mean his policy was up. These big entities, we heard about, there's a record label, I keep forgetting the name, but all these people that passed away, what's the young one in XXX, and all these random setups, right? All these people that passed away happen to be on the same label, right? And now they're looking at the label owner. Why? Because potentially he could have had a key man insurance. He put a key man insurance, and it was and yeah, right. We know the rest. So, but you gonna do the right thing. You have a business owner. I'm sorry, you're a business owner. You have a key employee, right? Or you have so you have a key employee that does everything for your business, right? They know your business pretty much better than you. Well, what happens if they pass away? You need to keep your business sustained, right? And be able to make the money that you would have made had they been there. So you get a policy on their life, right? Or you can be on your business partners as well, right? Buy-sell agreement, right? This is often set up with an attorney, right? And so with the buy-sell agreement, there's two different types, but basically what happens is that, let's say it's me, AJ, and TiVo in a business, right? And now what happens is that we're gonna basically say, if anything happens to us, we're buying an insurance policy, right, to sell, and we're agreeing to sell our portion of the business to one another, right? Because if something happens to me, right, does TiVo and AJ want to be in business with my husband? Do I want to be in business with TiVo's wife? Right? We don't know that. They may have a completely different business model than what we've had, right? And so you have these policies in place to make sure that you can buy the partners out, right? It's essential. We're business owners. You got to think like a business owner. You can't think small scale, right? Even if you are small, you start where you are and then you develop over the years. And this is where I am right now. There's a few more states that I am located in, but I can pretty much help in any state. If not me, one of my agents, I can help all over the world. If you have questions, you want to get deeper, because this can be very specific to you. All you need to do is you can follow me on my Instagram. I'm allowed to drop that, right? Oh, Shanice is changing lives, right? So I think I have it here for y'all, right? So my Instagram is here, Shanisha's Changing Lives. Just follow me there. You can go onto my calendar, sign up for free consultations, free FREE, right? Complimentary. This is for people, right? Get your information, ask your questions, any questions that you may have in regards to insurance. If you want to set up a policy, I can definitely take on new clients, set up a policy. Some of the cousins are already my clients, so you know, maybe they could say a thing or two about me. I pride myself in being very, very educated and knowledgeable on this subject matter. So yeah, so again, that's me. That's my Instagram. Follow me. If you guys have any questions, I saw some questions. Let me see if I can touch on like 5 real quick. You guys have any questions, TiVo and AJ?
No, I don't have any questions. I appreciate you presenting all this information. A lot of that was new for me. So
you're most welcome. I'm glad you guys learned something. And
yeah, so I typically go with whatever the job give me. Sign me up for that, and I'm cool. I don't be paying attention to nothing else. But you know, that's the ignorance in me. You feel me?
Same here, because the fact that if you leave the job and you can't take it with you, that caught me like,
yeah,
I need to check.
Right. And you know, but we're growing. You know, a lot of people, we don't think about that. You know, when it comes down to wealth building, it is a full financial picture, right? It's everything. It's not just stocks. While we're learning that, and it's beautiful, we can cover ourselves in other areas while we really build up that, you know, our stock knowledge, our investment, our trading knowledge. You understand? Cover our basis, right? That's what the foundation is. So for me, when I'm teaching people, I'm educating my clients, you have to reverse engineer the process. We have to start with the foundation, because when you build a house, you don't start from the roof, you start from the foundation up, right? So we cover the basis, right? And then we go up from there. So someone asked me, sorry, I just saw one and just kept going. What happens if you don't pay back the money you withdraw? So the money you withdraw in a policy, it all depends on the policy that you have and the way it's structured. So if you don't pay the money back, which I kind of mentioned already, depending on the policy, it could just come from your death benefit. Now, for me, that makes sense. Like a loan that I don't got to pay back, sign me up, right? The challenge is that, again, I talked about us being underinsured. And so because we are underinsured, let's say you only had $50,000 coverage and you took out a $30,000 loan, you leaving your family with less than $20,000, right? So because because of that, that's a problem. But now if you have a $300,000 policy, you took out a $30,000 loan, that's a different story. Someone said I'm in the wrong economics class. I probably am. It was much better when Mark started teaching me in the matrix, but because my college class, I was like, nah, this is not it. But let me see. Sorry. Just had a quote recently done. 35,000 whole life with 200,000 accidents for both hubby and me, quoted at $260 a month. Not sold because 200,000 accidental is our high premium. So right there. So that question was for Lillian Smith. So you got to ask yourself, 35,000 whole life and 200,000 accidental, right? What is the chances of you dying by accident versus actually dying a heart attack, getting sick, long life? Like, what do you understand? There's more odds in that. So if you have an accidental policy, if you had a regular policy and you died by accident, you're going to get paid out. But if you have an accidental policy and you die by natural causes or whatever, you're not going to get paid out. So it makes more sense for you to have more permanent coverage, the whole life aspect of it, than the accidental. So if you want to reach out to me, feel free to, and then maybe we can compare something. I work with over 150 different companies to service clients. So one thing about me is I work for the people, not for the companies at the end of the day. Let me see, one more question. What's a fun one? Man, I can't even see. Does the premiums on a life insurance policy consider your zip code, lifestyle risk factors similar to car insurance? Yes, they do consider, not really your zip code, unless that's something that's low key that they don't really tell us about, but they consider like your driving record, right? So if you have a crazy driving record, they're going to look at that. If you have the older you are, the more your premium is going to be. Any health conditions, they're going to take that into account. So it's not really about your location. It's about, your lifestyle and things like that. So yeah. So there's a lot of questions. I don't have time. I'll probably try to come back in the chat and answer some, but also, again, just reach out to me. I promise I will answer as many questions. I go live on my Instagram all the time. You can find me there. I didn't mention it, but I'm an author. Y'all probably saw Mark with my book, right? My children's book, You're Always Broke. Don't worry, y'all, we're not broke. It's just culture talk. But yeah, so just reach out to me. I'm very, personable. So yeah.
Appreciate you.
Thank you.
Got me wanting to dive into the infinite banking more and stuff. Look at you, sis, educating the people.
Let me tell y'all, it's crazy out here. It's big money, big opportunity out here. Trust me.
Yeah, no, I believe it.
The more you learn, the more you earn. Sometimes what you don't know is, that's what can make or break you. So I appreciate you.
Yeah, no, that's a fact. We definitely appreciate you. Appreciate you, just being ready, because I did need somebody. You been had your presentation ready, so I was like, man, I'm gonna just keep that in my pocket just in case. I called her on there and she was ready to go. So we definitely appreciate you presenting that. It's kind of a mix up from the typical investment things, but it's all about wealth. It's all about being well-rounded in your wealth knowledge, being able to come up to the come up page, you feel me, and get everything you need in one. That's kind of what this series is about. So we definitely appreciate you. AJ, you want to give us the what we need to know for
ahead. Yes. So for the week ahead, y'all, let's talk about earnings first. So for earnings, what I'm looking at is, with everything going on with Russia and Ukraine and the whole cyber issues, right? We got CrowdStrike reporting on Wednesday. Okay. So I'm paying attention to CrowdStrike on Wednesday. On Thursday, we got DocuSign, Rivian, Oracle, Blink, and Ulta. Okay. Shout out to Q. Got me paying attention, looking at Ulta. Check and see how they've been doing in the targets, all that good stuff. Also, keep in mind, if you follow semis, you got AMAT and QCOM having dividend increases this week. Okay, so if you trade the semis, make sure you're paying attention to that. Everybody who knows me knows I love Apple, and they have a product event coming up on Tuesday. So I know we're all going to be anticipating that, wondering what they might be dropping for this year. So pay attention to Apple on Tuesday, y'all. And then economics for this week, we got JOLTS, which is your jobs opening on Wednesday. We also have the 10-year bond auction on Wednesday and crude oil inventories on Wednesday. Another thing, on Thursday, pay attention to your core price index. So you got CPI data coming out, all right? So when we're talking about inflation and everything, be on the lookout for that economic report coming out on Thursday, as well as jobless claims. Other than that, it is a lot going on. Futures seems to be doing a little drop it like it's hot. So everybody just keep continuing to make sure you keep your head on the swivel. Make sure you're looking for confirmation for any trades that you get into, especially leaps, because you don't want to be out here just catching falling knives. So make sure you have a plan and follow it. But other than that, that's all we got.
We appreciate that rundown. It looks like we're going to have another of the same thing. It's been the same thing this whole time, so you can't even be surprised or say it's crazy no more. Oil keep going up. XLE keep going up. Futures keep being down Monday morning. We keep getting little pops here and there that get sold off. So, we not new to this no more. I don't want to hear nobody, not knowing what to do or, getting their money took. Like, not only did we see this last year, we've been seeing the same movement all year this year. You feel me? So, just keep researching, keep getting comfortable in the market. Don't run away from the market. Get comfortable in this place, because you start talking about wars, you start talking about inflation, recession, all these different things. The stock market is going to continue to react to that stuff. So if this is something that we're going to be going through this whole year, maybe into next year, we still have shortages. Who knows how all of this stuff is going to affect just what we got coming into next year, because we can't just go into next year smooth coming out of war and, economy issues and rate hikes and all of that. You feel me? So the stock market ain't going to be normal anytime soon. You feel me? So you trying to duck off, and just not pay attention at all, you're never going to come back at that point. You just going to miss a whole bunch of, knowledge and, just being comfortable in the environment. You feel me? So it's like once you start getting that knowledge, you'll be able to start making more moves and understand your position in the market so that you can still make money in these types of markets. Like me personally, I've just been buying stocks. I've been telling y'all that. Somebody said, oh, you don't be giving as much advice anymore. I don't have no advice to give you. I've been buying stocks. You feel me? I'm not finna be giving y'all all these charts and all this and that and trying to have y'all, take all these risks, because that's essentially what it is. Any cause that you placing right now is a risk. I'm not finna run y'all into no fire. You feel me? I'm not gonna do that. So I'm buying stocks myself, playing it safe. If it drop, I might buy some more. I might have another level that I might buy it at. You feel me? Now I am watching CrowdStrike. The only thing that gives me caution is what they did to Z-scaling.
Yeah.
They did the Z-scaling was very disrespectful. You feel me?
Very disrespectful.
And that was right after. That was like the same day. The day that they had earnings was like a cybersecurity pop. And then they got sold after post-market. So I didn't like how they did that. That's what's giving me caution, but I like CrowdStrike as a company and their future. So that will be something I'm watching this week. But again, Shanisha, we definitely thank you. We appreciate you. Make sure y'all check out her Instagram. This ain't no, we're not trying to sell you nothing. She give out a lot of game, a lot of knowledge. But she been doing this. She ain't new. She not no guru that just popped up last week with a gum road. You feel me? Like she got her licenses. She been doing this. So tap in with her, DM her if you didn't get your question answered. Leave a comment. She might slide through and answer it. Did you have anything else for them?
I was just gonna say, pay attention to insurance companies. I think Mark even mentioned it before. They've been running up a bag. So I said go where the money is, right? So
listen,
you're gonna be
go where
buying
the
them.
money is.
You're gonna be buying them as stock. You're gonna be buying them as policies because you're gonna get your money back when people. You understand? We know how this goes, right? You're gonna be trading them. Pay attention. Pay attention. It's not hard.
It don't matter what business cycle we in. Insurance companies are gonna get their money.
That's a fact.
Times like this, think about the defensive sector. Like you said, follow the money, go in oil. Like if you just have to play options, like at least follow the money. Like do not go against the trend because tech is not it right now. It's just not there. That's okay. That's why we say diversify. Go back to Sector Sundays, look at the breakdowns, do whatever you got to do. Just have a plan. That's all we ask. Just have a plan.
It's a good idea. You need some more assistance with this market, go back to the catalog, man. We done did plenty of material on safe sectors, defensive sectors, you feel me? So go ahead and brush that up, y'all. But we're not gonna hold y'all too long, man. We appreciate y'all. It was a little bit late, but we got through it. AJ, did you have anything else for we sign off?
No, bro. Peace and blessings to everybody in the family.
All right, y'all. Stay safe. Y'all be good.